Hello and welcome to another episode of the Business of Business podcast. I'm your host, Roy. Of course, we are the podcast that brings you a wide variety of guests that can talk to a diverse set of topics. Hopefully, we can shine a light on something maybe you haven't thought about, or at the very least, provide you with information and professionals to help you solve some problems that may be keeping you up at night. Today, we're excited to have with us Chris Younger. He is the founder of Class 6 Partners, a Denver-based financial services firm providing investment banking, wealth management, and business exit preparation services for middle market companies. Class 6's mission is to enable the entrepreneurial spirit by helping business owners get the most out of their investment of time, energy, and money in their business. Chris, thanks so much for taking time out of your day to be with us.
Well, thanks for having me, Roy, and thanks for doing what you're doing for your listeners.
Yeah.
It's a great service to them.
Well, I appreciate that. It's so much fun. I get to meet awesome people like yourself from all over the world. So it's, it's kind of the best gig in the whole world. I love it.
That's terrific.
So let's start off with a little bit about your history. I've got so many questions, I don't even know where to start. But let's start from the beginning. Let's start with, kind of your history, how you found yourself here, and then you can also tell us, I like the explanation of Class 6. You can tell us about that too.
Oh, you bet. Happy to do it. And, in terms of history, my wife accuses me of having a little bit of career ADD. I started out as an attorney. I worked for a federal judge on the Seventh Circuit Court of Appeals for about a year, and then spent a couple years practicing corporate and securities law in Silicon Valley, a firm called Wilson Sonsini. And quickly figured out that I didn't much care for the law, and I have to be careful because my wife's an attorney. But, and so I left legal practice to start with an investment group. It was an investment group that was funded by a utility, and they were investing in unregulated businesses. Okay. And so at a fairly young age, I was able to help them develop a consolidation strategy in the communications industry. And I was the lead acquisitions person. And so I would go out, source acquisitions, and then manage the acquisition process. And so it was a pretty intense experience. We completed 27 acquisitions over about 25 months.
Wow.
So
that's a heavy schedule.
Yeah, lots of travel. And as you might expect, when you do that many acquisitions in that short a period of time, you make your fair share of mistakes.
Yeah.
I always like to joke. For about a third of those deals, I looked a lot smarter than I am. About a third of those went exactly as planned. And then about a third of those I probably should have been fired for doing. Right. So I did the acquisitions and then moved into an operating role. I became the chief operating officer and the president of that business. At that time, we had grown it to over $1 billion in revenues and was responsible for the integration of the businesses. And we did a big systems conversion. And then we sold that business to Avaya, which is a large communications company, back in 2003. And then I actually tried to retire for about a year and a half. And it was after organizing my wife's spice drawer that she told me I needed to go find a hobby, maybe in a little bit more colorful language.
Yeah, right.
And so with my partner, we started our investment bank, and we originally started it as a hobby, really just to do a deal or two a year. We really like working with entrepreneurs. But as the business progressed, we got busier and busier. And so we were fortunate to be able to hire a lot of really, really great, smart, talented team members. And today we've got a team of 23 people.
Wow.
Across our business. And like you, I feel like I've got the best job in the world. I get to talk with entrepreneurs every day. We get to help them with a really meaningful and important transaction in their life. And with the advent of our wealth management, for a lot of those entrepreneurs, we get to work with them and their families, for the rest of their lives, and hopefully the rest of their families' lives as well. And so it's been really, really rewarding. And we've worked with, I think we've completed almost 100 transactions in that, in the 15 years since we started, 16 years since we started. And it's, like I said, don't get me wrong, I love doing transactions, but it's really getting to know these entrepreneurs and call them friends once we're complete has been really gratifying.
Yeah, and that's an awesome transition because, selling a business, especially a smaller one, I mean, that's somebody's baby, that's somebody's child that they've nurtured and grown. But I think that's an awesome transition. Once you've built that relationship and built that trust, then you can help them on the wealth management side, once that they decide to retire.
Yeah, it's when you think about for an entrepreneur, to the point you just made, Roy, it's their business is usually their largest investment.
Mm-hmm.
And prior to selling their company, they're usually, I call them asset rich and cash poor, right? Most of their cash is going back into the business. And if we can get involved with them 2 or 3 years before they're going to sell, you can actually do a lot of things from a tax standpoint, from an estate standpoint, from educating their kids about money management, budgeting, that you can have a much more significant impact than what typically happens is an entrepreneur might sell their business, come into a bunch of cash, and not necessarily know what to do or how to do it. And, at that point, you've got every wealth manager in the world trying to get their money, but it's usually too late to really accomplish a lot of the things that we can accomplish earlier on if we get involved before they actually transact.
Yeah, and it's like you said, when they're in that position, the other unfortunate part I've seen is that, they have kids and family members that they end up giving all their wealth away and still have quite a ways to go in life to make it. And I've seen some that have had to go out and get menial jobs just to try to live in that. So it's so important. I think it's also the other thing that's always on my mind is people that may think that they want to sell or we're getting close. And I'm going to let you answer this, but you can't wake up on Monday morning and say, I'm ready to sell and put a for sale sign out in the front yard. And it's a lot more preparation that goes into that.
Yeah, it's, for our clients, they kind of fall into three buckets, right? You have one bucket are folks that they've been approached by somebody, and for whatever reason, I mean, a lot of business owners get approached quite a bit for people wanting to buy their business. And for whatever reason, this particular one, they've decided this is the one and I want to go sell my company. And we'll get that call just to help them navigate that transaction. It's a fairly complex process. So you have about a third, you have another third who know that they want to sell their business, but they want to run, a full process. They want to go talk to multiple buyers. They want to put their story together and tell it in a compelling way. And so they run our traditional investment banking process. And then you have this other third, I call them kind of the intentional planners. They know, hey, in 5 years, I want to sell. So what are the things I ought to be doing today in my business, whether that's, building my management team, diversifying my revenue stream, taking certain risks out of my business. What are those things that they can be doing today that set them up such that when they do go to sell, they get the most out of it and, get the most money and the best transactions. And I can tell you in those thirds, we can get very successful deals done in each one of those buckets, but those business owners who are really intentional and plan ahead, by far the most successful transactions that we work on.
Yeah. Yeah. Cause I can only imagine, trying to clean up an income statement, a balance sheet, and then also, if it's the right size business where the owner whose name is maybe even on the business, but he's the guy that's at the top, there's always a sustainability question. And I really like the point you brought up is that if you've got that 5-year time horizon, you can actually bring some management in and kind of start slowly stepping away where you can prove to buyers that, hey, this is a sustainable business without me coming in every day.
Yeah, what's interesting is for business owners who undertake that effort to bring in a team to start to delegate their day-to-day responsibilities, a couple of things happen, all of which are positive. One is that business owner starts to get potentially more of the life that they want outside of the business. Right. They're able to, most business owners are typically type A. And so this allows them to actually either spend more time on the things that they really like doing in the business, or get more free time for them and their families. And so that has the corollary benefit of increasing the value of the business. As you said, if that business owner is the key revenue generator or has their hands in every facet of the operations, for a buyer, that's really risky because, as we all know, if that business owner cashes a nice check, their incentives are going to change, and that creates risk for the buyer if they don't have a good team underneath them. But having that team kind of correspondingly decreases potentially the need for the owner to sell, because if they're generating good cash from the business and they've got a good team, they may have a perfect life for them, which is great. That's the position you always want your business owners in. We call it being indifferent to whether a deal happens or not. If they've got a great company and they're comfortable continuing to own it, that means that any deal that they do is going to be the very best deal possible, because it has to be so compelling as to convince them that, that's better than continuing to own and operate my business.
Right. So let's go back to the beginning just a little bit. Let's talk about what's the difference in the ways that we, as a business, can get money. We have a loan, we have the underwritten by SBA, but we also have, investment bankers, angel investors. Can you just briefly touch on all these different types, and then, kind of what space that y'all fill there?
Yeah, you bet. So if you think about, we call it a capital stack, and as you said, you start at the least expensive, but the most restrictive is, a bank loan, right? The bank loans today have relatively low interest rates, but they're going to have covenants and restrictions on the business in terms of what it can and cannot do with its cash flow. And at the very top of the equity stack is common equity, which is the most expensive. It's going to dilute the business owner the most in terms of their ownership, but it's the most flexible, right? It typically doesn't come with covenants or restrictions on what the business owner can do. And in between there, you have in that debt stack, so you start with bank debt, and then you might have third-party debt that aren't banks, but are more flexible lenders. Interest rates are going to be higher, but they're more flexible in terms of what the business can do with the capital. And then as you get into equity, you might have a preferred equity, which could have a dividend or what we call a liquidation preference, meaning their money comes out before a common shareholder's money comes out. And there are different players in terms of investors at each one of those stages. So, for example, for a young business, obviously about banks and SBA loans. Those are traditional commercial banks that can lend money. There are also mezzanine lenders, which are those folks that provide debt that may be more expensive but more flexible. And then you have venture capitalists that provide capital, usually in the form of preferred equity, to businesses that are relatively young. Maybe that's prior to when they actually have revenues or prior to when they have earnings. And then you have private equity that typically like to invest in businesses that are more mature and have free cash flow, where they like to typically either provide growth capital, or they may actually provide a majority of the capital and what we call a recapitalize the business. Our job as an investment bank is usually at the later stages of a business, which is when a business is ready to raise capital, not necessarily venture capital. I think venture capitalists a lot of times have sort of an allergic reaction to investment bankers being involved. But we typically get involved when they're looking to raise growth capital from private equity, or they're looking to sell or to recapitalize their business. And we'll help them put their story together, identify the bidders, manage the transaction process, help them get ready for diligence, and then manage that whole process to closing.
Yeah, and it's so important to, maybe you're good at running your business, but this is a very complicated process, and I'm sure that the larger, more complex businesses, it gets even more and more complicated. But, each one of these, debt or investors, they have different things that they want. Of course, debt, they want you to pay it back, pay it back in the scheduled time. But at the investor part, sometimes people want to invest the money and then they want to get out within a couple years. Sometimes you have these groups that maybe they want to come in and perform a little bit more of the management oversight or send their people in. And so anyway, that's one reason why I just advise people seek out a professional that has the understanding, because I'm sure it's like my house that I get probably 2-3 calls a day. Hey, we'd really like to buy your house. And of course they do, about half the price. And so, I assume businesses are probably in that way trying to get squeezed out. And that's the other thing I'm assuming you can help with, is that valuation, cleaning everything up and saying, this is what it should be worth.
Yeah, it's, it's a fairly, as you said, it's a fairly complicated process. It takes a lot of kind of expertise and experience, and there are lots of different ways, right, that the transaction can go off the rails. And so having someone who really understands, hey, here are the train wrecks that could happen, how do we prevent those?
Right.
But also, as you said, how to tell the business's story in a way that's going to maximize the value of that business.
Right.
Because we have found entrepreneurs and investors, they may say the same words, but their language is a little different.
Yeah.
Entrepreneurs think about their business in a certain way, and investors think about business in a different way. And so helping to translate that story so that the investment community really hears the story in the way that you want them to hear it is important. And I liken it to, it's like any other business process. If you were setting up a new manufacturing line for your business, most times you're probably not going to try to do that all on your own. You're going to require somebody who has done that before, who understands the equipment, who understands what you need to accomplish with that equipment. And it's no different, right? In a transaction, you want somebody who understands that process to help guide you, because it's the stakes are very, very high.
Yeah.
And mistakes can be really, really expensive.
Yeah, and I think I like the story part, because we all have a story. Things look one way on paper, but when we can tell the story. But the second part of that is who's telling the story. If it's somebody that you trust and it's in this business, done a lot of transactions, you can probably sit there with a lot more ease than, if I'm telling the story of my business and how great it. Anyway, it's always better for somebody else to tell people how great you are than you to have to you to have to tell people how great you are.
Yeah, it helps, and I think it's also good, right? I think business owners oftentimes are very comfortable with their business, and they're comfortable with the risks in their business, right? So, and sometimes that creates blinders for the business owner. They may not see their business the same way an outsider is going to see their business. And so having a third party objectively look at the business and identify, hey, you've got, and every business does, you've got some soft spots here that we need to shore up and make sure that we're prepared to address. It's just like sales, right? You want to know, hey, what are the objections that I'm going to hear when I go talk to this prospect?
Yeah.
It's the same with selling your company, only the stakes are a lot higher.
Right.
And so kind of anticipating those objections and being able to explain them and position around them is critical.
Yeah.
Otherwise, you'll leave money on the table.
So what is our climate right now? Is there a lot of money chasing a lot of businesses? Is there a lot of money chasing few businesses? What's that look like?
It's gotten a little crazy, Roy. We're as busy as we've ever been. I think we have 16 active deals right now that are trying to get done before year end, which is kind of crazy when you think about it.
Yeah.
And that's created by a couple of different dynamics. One is there is a lot of, they call it dry powder in our industry, but there's a lot of capital sitting on the sidelines right now looking for homes.
Yeah.
So it's over $1 trillion and a half dollars, not including the debt financing that they typically use. So maybe double or triple that in terms of capital that wants to invest in businesses.
Yeah.
And during the pandemic, there was probably a 6-month period where almost none of that capital got deployed. And for those managers of that capital, they get paid when that capital gets deployed, so they're anxious to get it to work. And so you have that on the kind of the demand side, and on the supply side, when Biden announced potential tax increases for capital gains, his proposal, which we don't think will pass at this level, 43% on capital gains, that drove a lot of business owners who may have been thinking about selling to conclude, I got to get out before year end.
Right.
Because the increase in taxes, if your deal's a $20 million deal and the taxes went from effectively 23% up to 43%, well, that's a couple $1,000,000 to you, $4 million to you, which is, that's meaningful. And so that on the supply side has driven a lot of business owners to conclude, if I'm going to get out, this is the year to go do it. And so I don't know what that holds for 2022, but for 2021, it's crazy.
So the something I just read this morning is that, product focused businesses, had been really under the gun through this pandemic. Everybody was staying at home. We weren't doing anything, so we're buying stuff. And then now they were saying that, we've got supply chain issues, but we're kind of moving out of that because now people are going out trying to have experiences. So is this something that we need to take into account, like how this pandemic affected your business, and that, if you have time, of course, it may not be the right time to do it. It may need to, take that 2 or 3 years to let's get out of it and have some sense of normalcy?
Yeah, it's a great question, because I think businesses fit into one of 3 buckets during the pandemic. You had businesses that suffered greatly where they couldn't do business, right? Yeah. Restaurants are a great example, or gyms, where their business just got shut down, and a lot of them couldn't make it out.
Yeah.
You also had businesses where there may not have been much of an impact at all. Software sales, businesses where you didn't necessarily need to be in person to execute the transaction. Those did pretty well. And then you had businesses, and we've represented a few of them, where actually COVID and the pandemic dramatically increased their sales. Yeah. We had a business that was in online training in the real estate sector, a business called the CE Shop that we sold late last year. And, that business did very well during the pandemic because students, instead of taking their classes in person, all moved online. And once they figured out just how convenient and cost effective taking those classes online was, that's a permanent shift. That's not going to go back to, somebody taking an online class. And so that business did very well. We have another business that was selling home fitness equipment, and, they literally would sell out as soon as they got inventory, because everybody wanted to stock their home gyms. Yeah. And that's also a trend that we don't necessarily see going backwards. Yeah. People, that convenience, the safety, and just the ease of being able to do your workouts at home, was a big boon to their business. Yeah. And so, there's, for each one of those businesses, going back to the importance of being able to tell your story. Hey, if your business really suffered, if you wanted to sell, you kind of have to be able to normalize for that hit to earnings. Yeah. And that's a story. For those businesses that did well, you also have to be able to convince buyers that wasn't a COVID bump, but it's a new plateau for that business, that they're going to continue to do well. And so it's, that it really depends on the business, on the industry. And now that we're out of COVID, you start to get some proof points. Yeah. Is the business continuing to do well, or is it recovered? And those will be helpful to be able to kind of tell the story in the right way.
Yeah. Yeah, I know it's very industry and product and service specific, but in your opinion, do you feel like we're going to remain like 75% of what we've been doing on the internet, or is it going back to 50%? And I'll use me as an example is, we've ordered some stuff over the, like groceries, we're pretty prolific orders of other stuff always, because the convenience of coming to your house and not getting out. But groceries, we were still always going to the store. But now that we were forced into it, we're staying with it. We're not going. I'm not going back to the grocery store.
Yeah, to your point, I think the jury's out. We have some clients that have a mix of online and retail focused business, and the retail has come back pretty strong.
Yeah.
And so, yeah, I do think there's a subset of consumers just like you, Roy, where hey, the online convenience, it's going to stay.
Yeah.
I think you have another set where they enjoy the shopping and the store experience, and and those I think those businesses will do pretty well. But overall, I would expect probably a more permanent trend towards online purchasing, just because people experience just how convenient that is.
Right.
For those of us that have an Amazon addiction, it's pretty easy to get on your phone,
Yeah.
and order things and have them deliver the next day.
It's
So,
Christmas every day. I was just looking back.
right.
I was trying to find something in my order history yesterday, and I'm like, oh my gosh, I've had something delivered just almost every day the last month or so.
Yeah, it's my wife gives me a hard time about the boxes that show up. So
Right. Yeah. So, I know that when we go through these transactions, it's important, people are looking at what is the profit margin, what are the revenues, expenses, things like that. What are some other things that people take into consideration that business owners really need to think about that may not be, on an income state or balance sheet?
Yeah, if you think about how businesses are valued, it's really, you can have two identical businesses in terms of their revenues and cash flow. But if one business is a lot riskier, right? Their revenues might be more volatile, their management team may not be as deep, they may only have a few big customers, they may have litigation issues or environmental issues. That business is going to be worth less than the business that doesn't have those risks.
Yeah.
We use an application, and I think I mentioned we'll make this available to your listeners for free. It's called Copilot, which allows a business owner to really self-diagnose. They can take this assessment, and it asks about 120 questions, but it's designed to uncover those risks, to be able to help educate the business owner. Hey, here are the things that an outsider looking in is going to see that makes my business less valuable. And we use it in our own business just to help us quickly assess a business, to know, hey, here are the things that we've got to either explain our way around, or if we've got time, go fix.
Yeah.
Because that'll make the business more valuable. But there's, we break it into 6 value drivers. You have the financial value drivers, you've got operational and organizational value drivers, you've got customer value drivers, you've got your team or employee value drivers, you've got strategy or strategic value drivers, and then you have market value drivers. And you want to look at each one of those to really understand, hey, where is this business situated? Does it have, what Warren Buffett calls a moat around that business that protects it from competition, or is it just I've got to run faster and jump higher type business, which is more risky?
Yeah. And I assume that at certain levels, there'll be a team either from your company or from the buyer that'll come in and do a lot of due diligence, walking around, like we used to say in the old days, kicking the tires and, seeing if there really is a plant here, we really do have employees, that kind of stuff.
Yeah. Due diligence these days typically takes between 45 and 60 days. And I really try hard to condition our clients as much as I possibly can, just how intrusive, how challenging, how frustrating that process can be. It is, I explained to them, it's like having your 3 worst medical exams all at once. It's very painful because sophisticated buyers, we've closed deals where the buyer has spent over $1 million just on the due diligence process.
Wow.
So that's their lawyers, their accountants, they've got environmental people, they've got insurance people, they've got employment and labor practices people. They have all kinds of outside advisors, and their whole job is to come in and assess that business to see where are the landmines, what issues are we going to have post-closing. And it's truly remarkable how many different players come in to do this due diligence.
Yeah.
And so as a business owner, you've got to prepare for that. If you're not prepared, life is going to be really, really challenging. And odds are your deal will probably bust because there's just going to be too many issues that the buyer uncovers. And, how this goes is if you're negotiating a one-off transaction where somebody's approached you and they want to buy your company, uh, you're going to put your best foot forward, right? You're going to try to tell your story the best way that you can. They may make an offer on your business based on the story that you've told them. And as that story starts to unravel during diligence, as they start to learn the truth, the price is going to come down. You're going to feel like they're trying to nickel and dime you. And ultimately that transaction will fall apart because the trust breaks down.
Yeah.
So being prepared and really, if you've got an issue in your business, you kind of have to lead with that so that the buyer understands that and prices that in so that it's not a surprise later.
Yeah. And while it's hard because like I mentioned earlier, this is our baby that we've raised and brought up and lived with for many, many years. We don't want even if we know we've got a little kink in the armor, we don't want somebody else calling that out. But like you said, if we don't know and somebody else finds it, I think, we kind of almost have to look at that as a free opportunity that, somebody pointed this out. We can fix it and make it better for us. That may change our mind. We may want to be like, oh, well, this isn't so bad now that we fix this. Or, we just need to spruce it up a little bit to, engage the next buyer.
It's interesting. We had a deal 3 or 4 years ago, and it was a business that had a lot of revenues. They were a utility services company, and so their customers were utilities. Well, their biggest customer was probably 70 or 80% of their business. And when we first took them to market, we knew this was going to be an issue, but it actually prevented any deals from happening because that risk with that big customer was too much.
Interesting.
And we got one bid, and then the owner said, hey, let's take a step back. And so what we did was we worked on that relationship. Instead of having one contract with that main customer, we broke it into 4 contracts. Instead of having a 1-year contract, we got it into 5 and 7-year contracts.
Okay.
Instead of having the relationship just at the CEO level, we built that relationship all the way through the organization. And then we were able to take them back out to market, and the value of the company probably doubled just by taking care of that risk.
Interesting.
And it was it's a great story to your point of, hey, if your first deal busts, it's not the end of the world, and it's given you great feedback on the things that you can do to drive more value in your business. And usually like I said, we've had story after story like that where, the second time around, the business has just been worth a lot more money, and it's been to the owner's benefit.
And it gets back to time. If you have the luxury of time, get out ahead of this, because I think the people, again, that get hurt the worst are the ones that maybe it's not maybe it's a health issue, or maybe it's just like, I'm just over this. There could be a lot of reasons, not necessarily financial, or that have to do with the business itself, but you can take a huge hit on the price just trying to get out too soon without handling this stuff.
No question. And we see it all the time. There are risks that you can do a lot to fix or alleviate. And if you do that, your business is going to be more valuable. And to the point that you made earlier, Roy, it's going to make the business more fun to manage, right?
Right.
If you're not dealing with all those risks day to day.
Yeah. It's like, hey, thanks for taking care of that. I think I'll stay around. It's fun now.
Yeah. I actually enjoy it.
Right. So I know we're getting short on time, but one more question is, like, what about owners staying around? I guess it can depend on the business, the size, a lot of variables, but just in general, are these transactions where it's like, just, we're done, you're out, and you've got your money, or did they have these consulting contracts where they want them to hang around for a year or something like that?
So, Again, I'm going to use the 3 buckets,
okay.
right?
Okay.
The first bucket are business owners who maybe they're younger and they want to stick around and grow the business to the next level and maybe sell it again. We've had a lot of instances where a business owner they may have sold 80% of the company, but they reinvested 20% with the new buyer.
Okay.
And then they stuck around. They were the CEO for that next sale, right? 3 or 5 years later. And they may have made more money on the second sale than they did on the first sale.
Yeah.
And so, there's that type of owner who can successfully transition from being the entrepreneur to working with an outside investor and managing for that investor.
Yeah.
That's probably maybe 30 to 40% of the time.
Okay.
The next bucket are business owners who, they want to transition, but they're willing, and ideally they want to stick around for 2 or 3 years, because that will help ensure the best transition for the business. That takes best care of their team. It cares for their reputation. It'll just make that transition smoother. And then they work with the buyer to find the next CEO.
Okay.
And that's maybe another third. And then you have a third of business owners who they just want out when the transaction closes.
Yeah.
Now that tends to decrease the value of the business, because it's now riskier, right? Because if that business owner were really involved and they're now gone, that makes that business much more risky. So it's, we always advise business owners, if they don't have a really strong team, you should plan to stick around for at least 2 or 3 years after the deal, just to make the buyers comfortable, because that'll add a lot of value to the deal.
Yeah, the guy that comes to closing in his tennis shoes and kind of down in the track blocks, getting ready to jet out, probably makes the buyer a little nervous.
Oh, it's definitely.
One more thing I thought about while we're talking about that is, what about like clawbacks, or, I'm sure this isn't just as like it's a done deal and, buyer beware in some of these transactions. Are there actually clauses written into contracts, or how does that work in general?
Yeah. So when you sell a business, you're going to make a series of statements about your business in that purchase contract. You're going to state that you don't have any environmental issues. You don't have any litigation issues. You don't have any, your financials are accurate. And usually there's probably 25 or 30 reps and warranties, we call them, which are the statements that you make about your business. And in some deals, the buyer will take 10% of the purchase price, say, and put that into an escrow account. So if you're sold your business for 20 million, they might take 2 million and put that into an escrow account, so that if you sell your business and it turns out that one of the statements that you made was false, right, whether knowingly or unknowingly, about your business, then the buyer's got recourse against that 2 million. And if it's, a big issue, they could come after you for more than that. Yeah. Typically it's limited to the escrow. Okay. But that's, again, it's kind of like providing a warranty on the car, right? You're representing, this business is a sound business. It doesn't have all these different issues. I don't know about any surprises that you might find as a buyer. And if there are surprises, that's where the contract comes in to determine, is that going to be on the buyer's nickel, or is there going to be on the seller's nickel? And so back to the complexity, that's where you want, great transaction attorney who knows how to protect you as best he or she can, as it relates to that transaction.
Okay. All right, Chris. Well, the other thing you were going to tell us about, Class 6 Partners, I think that's an awesome name, but where did that come from?
So during COVID, we decided we needed to do a rebranding, and Class 6 is a classification system, right, for rapids. We have whitewater here in Colorado, and Class 6 are, those rapids that haven't been navigated before and are treacherous. And so, as we like to say, as you're going down this process of potentially selling your business or raising money, it can be quite treacherous if you're not familiar with the river. Yeah. And so as a guide, right, hopefully we'll reduce your chances of something really bad happening.
That's a great visual. I love that.
Yeah.
Well, Chris, we appreciate you taking time out of your day to talk to us. It's been very informative, and I have to get you back on. We could talk for another couple hours, I'm sure. This is exciting. I can see your passion for what you do really shines through. So I think that's awesome as well.
Well, thank you so much for having me. And likewise, it's great that you're doing this for your listeners, and always happy to help entrepreneurs.
All right. So before we go, a couple questions. First off, do you have a tool or a habit, something that you do every day that you feel like adds a lot of value personally or professionally?
I will tell you that for me, it's exercise.
Okay.
In our careers, things can be pretty stressful, and so my morning starts out with a little bit of reflection on kind of what's important, and then usually in 45 minutes to an hour of some type of exercise, and that just helps me kind of level set and clear my head.
Yeah.
And it's I've done that for probably 15, 20 years, and it's worked
Yeah.
out really well.
Yeah, I like that even during the day. If I get blocked up, just taking a 10-minute walk outside just really clears your head and come back and you're like, wow, that problem wasn't as big as what I had made it into. Just getting a little air.
Yeah, 100%, 100%.
All right. Well, tell people who you like to work with. Of course, what can you do for them and how they can reach out and get a hold of you.
Sure. So our ideal client is really, it's an entrepreneur, typically with a business that's, probably more than 5 or 10 million in revenues. And the best clients for us are really what I call lifelong learners. These are folks who love to better themselves. They love to better their businesses. They want to learn more. We're going to be a great fit for them, and they're going to be a great fit for us. And we, like I said, we love working with those entrepreneurs. If they have an interest, they can reach out to me. My email address is Chris, CHRIS, at Class 6 Partners. That's classvipartners.com. And happy to help anybody, whether we get formally engaged or not. Like I said, our mission is to enable the entrepreneurial spirit. And so even if we don't get engaged, I love talking with entrepreneurs.
Awesome. Yeah, and we'll include all that in the show notes as well. All right,
Perfect.
Chris. I hope you have a great afternoon, and thanks so much for stopping by. That's going to do
Well,
it. Oh, go ahead. Go ahead.
thank you so much.
You bet. You bet. That's going to do it for another episode of the Business of Business podcast. Of course, I am your host, Roy. You can find us at www.thebusinessofbusinesspodcast.com. We're on all the major podcast platforms, iTunes, Stitcher, Google, Spotify. If we're not on one that you listen to, please reach out. I'd be glad to add it to make your listening easier. You can also find us on all the major social media platforms. We typically hang out on Instagram more than others, so we'd be glad to engage with you there. Also, a video of this interview will go up on our YouTube channel, so go check it out. Till next time, take care of yourself and take care of your business.